Imagine finding like a secret lever that could adjust your paycheck,
Mm-hmm.
giving you more money exactly when you need it, or maybe helping you avoid a surprise tax bill later.
That'd be nice.
Well, today we're kind of pulling back the curtain on that very lever, the IRS Form W-4.
Yeah, it sounds dry, but it's surprisingly powerful.
It really is. It's not just some dusty old form. It's a powerful tool in your financial toolkit.
Absolutely.
And if you use it strategically, it can genuinely put more of your hard-earned money in your pocket, like right now.
Which is essentially a tax-saving method right there, getting your money sooner.
Exactly. So we're diving deep into the 2025 Form W-4, the Employees Withholding Certificate.
That's the official name.
And this isn't just about ticking boxes, rote compliance.
Not at all.
It's about making informed strategic choices that directly impact your take-home pay, your annual tax refund.
Or that dreaded tax bill.
Right, or potentially a surprising tax bill, and ultimately your overall financial well-being.
It connects to everything.
Our mission today is really to extract the most important actionable insights from this crucial document, helping you understand how to make your withholding work best for you.
Optimizing it.
Yeah, optimizing your cash flow and hopefully sidestepping those end-of-year tax surprises.
Think of it as a direct route to, well, immediate tax savings.
Just by understanding a form, most people probably glance at and forget.
What's truly fascinating here, I think, is that while the W-4 seems straightforward, maybe deceptively so, its nuances offer significant, often overlooked opportunities.
Opportunities for what, exactly?
For individuals to proactively optimize their tax situation throughout the entire year, not just at tax time.
So moving beyond just compliance.
Exactly.
Yeah.
It shifts from being just a requirement to a powerful element of proactive financial management.
Okay.
It's about making sure your paychecks accurately reflect your financial reality.
So your money works for you.
Right. Allowing your money to work for you every single day, rather than, sitting with the government as an interest-free loan until tax season.
We'll definitely come back to that idea of the interest-free loan.
It's a big one. And this immediately raises a vital question for everyone listening.
Which is?
Are you truly maximizing your current withholding to your advantage? Are you potentially leaving money on the table that could be in your pocket right now?
A really important question. Okay, let's get into the foundations. So let's start with the fundamental purpose. What's the big idea behind the W-4?
Well, at its core, it's pretty simple conceptually. It's designed to tell your employer precisely how much federal income tax to withhold.
From each paycheck.
From each and every paycheck. But the why behind getting it right is crucial.
Yeah, why is getting this correct amount so incredibly important? It seems like a small detail, maybe.
It seems small, but the ripple effects through your financial year are truly significant. If we connect this to the bigger picture,
Okay.
it's absolutely about managing your personal cash flow effectively.
Right.
Think of your W-4 as like a faucet controlling the flow of your money throughout the year.
Okay, I like that analogy.
So if you set it wrong, say too little tax is withheld from your pay over the year,
What happens then?
you'll likely find yourself owing a substantial amount when you file your tax return in April.
The surprise bill.
Exactly. And if that underpayment is significant enough, the IRS isn't shy about hitting you with a penalty on top of the tax you already owe.
Ouch. So tax plus a penalty.
Correct. Nobody wants that surprise, especially one that comes with extra charges and can, derail your budget.
Yeah, that's a major financial headache.
It is. And it's one that proactive W-4 management can definitely help you avoid.
Okay, so that's withholding too little. What about the other side?
The other side. And this is a very common scenario for millions of people, withholding too much.
Right, leading to the big refund.
Exactly. If too much tax is withheld, you'll typically be due a refund at tax time. Now, while a refund can feel nice,
Like a bonus.
it feels like a bonus, a little windfall maybe, but you have to remember it's actually your own money coming back to you.
Money you overpaid during the year.
Precisely. It means you've effectively given the government an interest-free loan for months, sometimes the entire year.
Okay, there's that phrase again, interest-free loan.
It's key. That's your money sitting in the government's account, not earning interest for you, not available for your immediate needs.
Like paying down debt. Or investing.
Exactly. Paying down high-interest debt, investing, handling emergencies. This is a key area where many people can achieve immediate tax savings, quote unquote,
How so?
by optimizing their W-4. By adjusting your withholding accurately, you can have more money in your pockets with every single paycheck.
Instead of waiting till next spring.
Right, rather than waiting until next spring to get it back as a lump sum. It's about putting your money to work for you now, every payday. That's real cash flow optimization.
That's a really crucial distinction.
Yeah.
That refund isn't found money, it's your money you overpaid. Okay. So, since life isn't static, things change. Neither should your W-4 be static, right?
Absolutely not.
It's not a one-and-done form you fill out when you start a job and then just forget about.
Definitely not. That's a common mistake.
So when does the IRS actually recommend you complete a new W-4?
Essentially, any time your personal or financial situation experiences a significant shift.
A shift that could impact your tax liability.
Correct. Anything that changes how much tax you'll likely owe for the year.
Can you give some examples? What kind of life events are we talking about?
Sure. Think about major life events. Maybe you got married or divorced.
That changes your filing status.
Right, which changes your standard deduction and tax brackets. Or perhaps there's a change in the number of jobs you hold.
Or your spouse.
Or if you're married and your spouse starts or stops working. That's a big one for step 2, which we'll get to.
Okay. What else?
Crucially, changes in dependence. Maybe you welcomed a new child into the family.
What's tragic?
Or perhaps an older child moved out and isn't a qualifying dependent anymore. That definitely should prompt a W-4 review.
Makes sense. Any financial changes?
Yes, significant changes in other income, like maybe you started a profitable side hustle.
Gig economy.
Right. Or you inherited money. Or maybe you started drawing retirement income. Also, if you become eligible for new tax benefits, like credits or deductions.
Or expect higher deductions than usual.
Exactly. All of those are triggers to update your W-4. It's really about keeping your withholding aligned with your current reality, not last year's situation.
Proactive, not reactive.
That's the goal.
Okay, let's walk through the form itself now, starting with the absolute basics. Step 1, personal information.
The very beginning.
This first step might seem incredibly basic, almost, obvious. Name, address.
Social Security number.
Right, but it truly sets the fundamental stage for everything that follows. This is the foundational data your employer needs.
To accurately report your wages and the taxes withheld to the IRS, it has to be correct.
And right there, in this supposedly simple section, there's a quick but absolutely crucial double check the form points out.
What's that?
It explicitly asks, does your name match the name on your Social Security card? Why does that matter so much?
It seems trivial, but it's vital. Ensuring your name on the W-4 matches your Social Security card is crucial for the IRS to properly credit your earnings.
To your Social Security record?
Yes. Discrepancies can cause problems down the line with your Social Security benefits calculation or even just delay processing your tax return.
So a simple check that saves future headaches. Good tip.
Definitely worth the 2 seconds it takes. And right here, still in step 1, is where the first layer of truly impactful tax-saving decisions comes in.
Really? In step 1?
Yes. Your filing status choice. It's fundamental.
Okay, explain that.
Your choice of filing status directly influences 2 major components of your tax calculation.
Which are?
Your standard deduction amount, how much income is automatically not taxed, and the tax rates, the actual percentages, that will be applied to your income.
And the W-4 gives you options here.
Right. 3 main options. Single or married filing separately, married filing jointly, or qualifying surviving spouse, or head of household.
Let's pause on head of household. That one seems like it might apply to more people than realize it.
It often does. It's a status many people might overlook but could significantly benefit from, tax-wise.
So what are the criteria generally?
Generally, you must be unmarried or considered unmarried for tax purposes and pay more than half the costs of keeping up a home for yourself and a qualifying individual.
Like a child or another relative.
Exactly. Think of a single parent living with their child and providing most of the home's financial support, or someone supporting, say, an elderly parent or another qualifying relative who lives with them.
And choosing the right status here has big implications for withholding.
Substantial implications. Selecting the correct filing status is absolutely fundamental to accurate tax calculation from the get-go.
What if you choose wrong?
An incorrect status could lead to consistently overpaying or underpaying your taxes all year long.
Directly hitting your immediate cash flow.
Right. And potentially leading to those year-end surprises, big bills, or unnecessarily large refunds that we're trying to help you avoid.
So even this basic step 1 choice is paramount.
Absolutely. paramount for accurate withholding and optimizing your take-home pay. It's really your first chance to make your W-4 work for you, not against you.
All right, let's tackle what feels like one of the trickiest parts for many households. Step 2, multiple jobs or spouse works.
Ah, yes, this is a big one.
This is where it gets really interesting, I think, for a lot of our listeners, and probably where many people face their biggest W-4 challenges.
That's very true. A lot of errors happen here.
So if you hold more than one job at the same time, or if you're married filing jointly and your spouse also works, this step is critical.
Absolutely critical.
Why does this specific scenario often lead to so many headaches, so many tax problems?
It's an excellent question, and it really boils down to a common misconception, or maybe just how withholding works by default. See, each employer calculates withholding as if their job is your only source of income for the year.
Ah, they don't know about the other jobs.
Exactly. But the correct amount of tax withholding doesn't depend on just one job's income. It depends on the combined income from all jobs in your household.
Right, because tax brackets are progressive, more income means higher rates on some of it.
Precisely. If you don't actively account for that combined income on your W-4, which is a very common oversight,
What's the result?
you can easily end up significantly under withholding tax throughout the year.
Meaning you haven't paid enough.
Right. So come tax season, instead of maybe getting a small refund or breaking even, you're suddenly faced with a large tax bill.
And potentially penalties again.
It's that classic example of where proactive W-4 management in Step 2 can save you a world of trouble.
And presumably keep more money flowing correctly during the year.
Yes, by getting the withholding right from the start. Now, the W-4 offers 3 distinct options to address these multiple job scenarios.
3 ways to handle it.
3 ways. Each has, let's say, varying levels of accuracy and therefore different implications for your paycheck and your final tax situation.
Okay, so understanding these options is key to optimization.
Absolutely. It's key to truly optimizing your withholding and keeping your cash flow steady, avoiding those jolts.
Let's break them down. What's option A?
Option A directs you straight to the IRS's own tool, the tax-withholding-estimator.
The online tool.
Yes, the online tool. You can find it easily at www.irs.gov W4EP.
And the IRS recommends this one.
They repeatedly highlight this as the most accurate and generally the easiest method for this step, and frankly, for tailoring your entire withholding using steps 3 and 4 as well.
So it covers everything.
It does. It's particularly recommended if you or your spouse have self-employment income alongside regular jobs, or if you just want the most precise withholding possible in any multiple job situation.
Any tips for using it effectively?
Yes, a very practical tip. Make sure you have your most recent pay stub or subs available from all jobs before you start.
Why is that important?
Because the estimator needs to know how much federal income tax has already been withheld this year. That allows it to give you the most accurate projection for the remaining pay periods.
Okay, makes sense. And the benefit.
The ultimate benefit here is that this option lets you fine-tune your withholding so precisely you can really avoid surprises.
Meaning more money each payday.
Ensuring more of your money stays in your pocket each payday rather than being overwithheld and just coming back later as a large refund. This is your best friend for maximizing that immediate cash flow.
Okay, the estimator sounds good. What's option B?
Option B involves using the multiple jobs worksheet. You'll find this printed on page 3 of the W-4 instructions.
A manual worksheet.
Right, a paper worksheet. Its purpose is to help you calculate the total extra tax that needs to be withheld across all your jobs to account for that combined income we talked about.
How does that work in practice?
The key procedure here, and this is important, is that this worksheet should be completed on only one Form W-4.
Just one, even if you have 2 or 3 jobs.
Just one. And ideally, you should do it on the W-4 for the highest paying job you have.
Why the highest paying?
That generally leads to the most accurate overall withholding across all your income streams. It ensures the extra amount is calculated based on the highest marginal tax rate you're likely facing.
Okay. And this worksheet, is it complicated?
Well, it does involve a series of calculations. You have to use tables provided right there in the W-4 instructions.
Tables based on income levels?
Yes. You look up amounts based on the annual wages of your higher and lower paying jobs, do some addition, maybe multiplication if there are 3 jobs, and then some division.
Division.
To figure out the extra amount to withhold per pay period.
Okay, so it's definitely more involved than the online tool.
It's certainly a more manual process. We probably shouldn't try to walk through every line here on audio.
No, that sounds confusing.
It would be. But the core insight is that it does help you prevent that underwithholding when you have multiple jobs. It lets you proactively cover your combined tax liability.
Were there limitations?
Yes. The IRS notes that if you have more than one job with annual wages over $120,000 each, or if you have more than 3 jobs total, the worksheet might not be accurate enough.
So then what?
Then they recommend using their separate publication, Pub 505, or, again, going back to the online estimator.
Which seems simpler anyway.
For most people, yes, the online estimator will likely be far simpler and more precise.
Okay, that covers option A and B. What's the third one? Option C.
Option C is the check-the-box method. This one is only available if you have exactly 2 jobs total in your household. Not 1, not 3, just 2.
Just check a box. Sounds easy.
It is by far the simplest option in terms of filling out the form. You literally just check a box on both W-4s, one for each of the 2 jobs.
How does checking a box fix the withholding problem?
Well, the way it works behind the scenes is pretty straightforward. When you check that box, it signals to the employer's payroll system to essentially cut your standard deduction and tax brackets roughly in half for that job's withholding calculation.
Ah, so it assumes half the tax benefits apply to each job.
Kind of aims to balance things out that way, yes. It sounds appealing because it's so simple.
But I sense a however coming.
There is a significant however, a big accuracy warning. This is where many people can inadvertently overwithhold tax.
Overwithhold, even though it's meant to help.
Yes. The IRS explicitly states right on the form that this option is generally more accurate than using the worksheet, option B, only if the pay at the lower paying job is more than half of the pay at the higher paying job.
Okay, that's a specific condition. What if the jobs have very different pay rates?
If the pay difference is large, say, one job pays much less than half the other, this checkbox method can lead to more tax than necessary being withheld, sometimes significantly more.
More tax coming out of each paycheck.
Correct. And here's the crucial part. This overwithholding tends to increase as the difference in pay between the 2 jobs gets bigger.
Can you give an example?
Sure. Think of someone, let's call her Sarah. She has a high-paying full-time job and maybe a small part-time side gig just for some extra cash. If Sarah just checks the box on both W-4s, because it's easy, she'll likely have much more tax withheld throughout the year than she actually needs to.
Leading to
A large tax refund next year, which, as we discussed, means she had less money in her pocket during the year.
that interest-free loan again?
Exactly. She gave the government a bigger interest-free loan than necessary. So while this option is simple, it's vital to understand its limitations, especially for optimizing your immediate cash flow.
So if your 2 jobs have vastly different pay, checking the box might actually reduce your take-home pay unnecessarily.
Precisely. It might not be the immediate tax-saving option you think it is in terms of maximizing your paycheck amount. Accuracy often suffers for simplicity here.
Wow, that's a really critical caution flag straight from the W-4 instructions themselves. Good to know.
Very important distinction.
And this leads us to another important point, a general rule for steps 3 and 4B that applies regardless of which step 2 option you picked.
Yes, this is a key procedural point.
Whether you use the estimator, the worksheet, or check the box. Steps 3 for credits and 4B for deductions should be completed on only one Form W-4.
Just one form.
And again, for the most accuracy, you should put those details on the Form W-4 for your highest paying job.
That's the recommendation.
Why only on one form? Why the highest paying?
The reason for leaving those sections blank on your other W-4s is simple: to prevent double counting your credits or deductions.
Claiming the same dependent credit on both forms, for example.
Exactly. If you claimed, say, a $2,000 child tax credit adjustment on both W-4s, you'd inadvertently cause significant underwithholding overall.
Because your withholding would be reduced twice as much as it should be.
Correct. Putting it all on the highest paying job's W-4 ensures your total withholding for the year across all jobs is as precise as possible, avoiding both overpayments and underpayments.
Okay, we've covered the basics in step 1 and navigated the complexities of multiple jobs in step 2. Now, step 3 feels like where the W-4 really lets you proactively put more money in your pocket. This is where you account for dependent and other tax credits.
Yes, this step is incredibly powerful.
Why powerful? How do these credits directly impact our take-home pay? What should listeners really focus on here?
It's powerful because it represents a direct reduction of your actual tax liability. This is different from deductions.
How so?
Deductions reduce the amount of your income that's subject to tax. Credits, on the other hand, directly subtract from the actual amount of tax you owe.
So dollar for dollar reduction.
Think of it exactly like that. a dollar-for-dollar reduction of your tax bill. Much more impactful than a deduction, generally.
Okay. So what kind of credits are we talking about in step 3?
Well, the W-4 specifically calls out two main categories of dependent credits first.
Dependents, right.
First, for qualifying children under age 17. Here, you multiply the number of children who meet this definition by a substantial amount,
Which is currently.
often $2,000 per child. But always check the current year's form or instructions.
And what makes a child qualifying for this?
Generally, the child must be under age 17 by December 31st of the tax year, usually live with you for more than half the year, and have a required Social Security number. There are other rules, but those are the basics.
Okay, $2,000 per qualifying child under 17. What's the second category?
The second is for other dependents. This is a broader category.
Who falls into that?
It could include older children who don't meet the age criteria for the main child tax credit, or maybe other qualifying relatives you support, like an elderly parent.
And the credit amount there.
For these other dependents, you multiply the number of them by $500 each.
Still helpful. Are there income limits on these?
Yes, that's important. These specific dependent credits do have income thresholds. For example, in recent years, they typically apply if your total income is $200,000 or less if single, or $400,000 or less if married filing jointly. These thresholds can change, so always verify.
But these are significant potential reductions in tax.
Absolutely. They can dramatically reduce your overall tax burden if you qualify.
And step 3 isn't just for dependent credits, is it?
No, not at all. That's another key point. The W-4 explicitly allows you to include estimates for other tax credits you anticipate being eligible for.
Like what kind of other credits?
Oh, it could be a wide array. Maybe the foreign tax credit if you've paid income taxes to another country.
Okay.
Various education tax credits if you or your dependents are in college or pursuing other qualifying education.
Like the American Opportunity Credit or Lifetime Learning Credit?
Potentially, yes.
Yeah.
Or even specific credits for things like energy-efficient home improvements, child and dependent care expenses, or adoption expenses. You estimate the total amount of these other credits you expect to claim.
So you add the dependent credits and these other credits together in step 3.
You add them all up, yes. The total goes on the line in step 3.
And what's the impact of putting that total number there? How does it save tax now?
The impact is straightforward and highly beneficial for your immediate cash flow, your paycheck amount. Adding these credits to step 3 will increase your paycheck because your employer will withhold less tax. Right, because the system knows you'll owe less tax overall.
Exactly. And consequently, because you've paid less tax during the year, it will also reduce the amount of any refund you might receive at year end.
Which we established isn't necessarily a bad thing.
Not at all. If your goal is better cash flow now, this is a direct, proactive tax-saving method, keeping more money throughout the year.
Allowing you to use that cash for savings, investments, paying down debt, whatever you need it for.
Rather than waiting for that lump sum refund next spring.
Precisely. It puts you in control.
And if people want more details on eligibility for all these different credits.
The IRS generally recommends consulting Publication 501, which covers dependents, standard deduction, and filing information. It gets into the nitty-gritty details.
Okay, moving on down the form to step 4. This whole section is labeled optional. Other adjustments.
Right. Optional, but potentially very useful.
This feels like the ultimate customization step, doesn't it?
It really is. If you want to further fine-tune your withholding, get it even more precise beyond the basics of steps 1 through 3, this is exactly where you do it.
Granular control.
Yes. It offers very granular control over your tax payments throughout the year, letting you truly personalize your tax strategy based on your specific circumstances.
So let's look at the parts. Step 4A is for other income, not from jobs. What goes here?
This subsection is designed for income types that you expect to receive during the year, but that typically don't have tax automatically withheld at the source.
Like what?
Think interest income from savings accounts, dividend income from stocks or mutual funds, maybe certain retirement income distributions.
Income that usually just arrives without tax taken out.
Exactly. By entering the estimated annual amount of this other income here.
What's the benefit of doing that?
The major benefit is that you likely won't need to make separate quarterly estimated tax payments for that income.
Avoiding Form 1040-ES.
Potentially, yes. Instead, the tax liability for this other income gets conveniently rolled into your regular paycheck withholding.
So your employer takes out a bit more from your wages to cover it.
Correct. It simplifies your tax planning throughout the year and helps ensure you don't face an unexpected tax bill plus underpayment penalties, because you forgot about that other income stream.
But what if someone prefers to make those separate estimated payments?
That's fine too. The form notes that as an alternative, you can simply leave Step 4A blank and handle it yourself using Form 1040-ES, Estimated Tax for Individuals.
Okay. And there's a privacy note here, too.
Yes, a small but potentially relevant point. The instructions mention that if you have concerns about providing the specific details of this other income to your employer on this form,
You might not want them knowing about your investment income, for instance.
right, if privacy is a concern, you can use Step 4C, the extra withholding part, as an alternative.
How would that work?
You'd basically estimate the tax you'll owe on that other income yourself, and then enter that amount, divided by pay periods perhaps, or just an annual estimate converted to per pay period in Step 4C as additional withholding.
So the tax gets covered without revealing the income source.
Exactly. It provides flexibility and privacy if needed.
Okay, interesting. Now, Step 4B, deductions. This sounds like another key tax-saving lever.
It definitely is, particularly if you're someone who itemizes deductions instead of just taking the standard deduction.
So for people with high mortgage interest, state taxes, charity.
Exactly. If you expect to claim deductions other than the standard deduction, and you want to reduce your withholding to account for these.
You want your paycheck to reflect those expected deductions now.
Right. You'll use the deductions worksheet, which is again provided in the W-4 instructions, to figure out the amount to enter in Step 4B.
Why is this crucial?
It's crucial for ensuring your withholding accurately reflects your anticipated lower tax liability due to having those extra deductions. Without this adjustment, you'd likely overpay tax all year.
Can you give a quick overview of how that deductions worksheet works?
Sure. It basically guides you to estimate your total itemized deductions for the year. Things like qualifying home mortgage interest, charitable contributions, state and local taxes, up to the current limit, often $10,000, significant medical expenses exceeding the threshold.
Okay, you add those up.
Then you compare that total to the standard deduction amount for your filing status.
Because you only benefit from itemizing if it's more than the standard deduction.
Precisely. The worksheet helps you calculate the excess amount, how much your itemized deductions exceed your standard deduction.
And that excess amount goes in 4B.
Well, you might also add certain other deductions like student loan interest or deductible IRA contributions. The worksheet combines these. The final result from the worksheet is what you enter into Step 4B on your W-4.
And the impact on my paycheck.
The impact here is significant and positive for cash flow. Entering an amount in Step 4B will generally increase your paycheck.
Because less tax is withheld.
Right. It reduces the amount of tax withheld because the system assumes you'll have these higher deductions when you file your tax return, resulting in less tax liability overall.
So it's a proactive way to get that tax benefit spread throughout the year.
Exactly. Instead of waiting for a larger refund generated by those deductions at tax time, it's about front-loading your tax savings into every paycheck. More immediate tax saving.
Great. Now, the last part of Step 4, Section C, extra withholding.
4C. This is arguably the most flexible tool on the entire form.
Flexible how?
It truly gives you ultimate control over your withholding amount. Here, you simply enter any additional tax you want withheld from each pay period.
Just a flat dollar amount.
Yes, a flat dollar amount per paycheck.
What are the common uses for this? Why would someone want extra tax withheld?
It has several important uses. First, and we touched on this is where the amount calculated from the multiple jobs worksheet, if you used option 2B, gets entered.
Okay. The result of that worksheet goes here.
Correct. That per pay period extra amount goes right into 4C. It's also a good option if you have other income, like from 4A, that you want to cover via withholding, perhaps for privacy reasons.
Instead of listing it in 4A.
Right. Or maybe you know you'll owe tax on something specific like selling stock for a capital gain, and you want to prepay that tax through your paycheck rather than making estimated payments.
Makes sense. Any other reasons?
Sure. Some people simply prefer to consistently get a larger refund at the end of the year. It feels like forced savings to them.
So they intentionally over-withhold using 4C.
Yes. Or maybe they just want to be extra cautious and proactively reduce any chance of owing tax when they file. Adding extra withholding here is how you achieve that goal.
And the impact is the opposite of 4B.
Exactly. The impact is clear. Entering an amount in Step 4C will reduce your paycheck for each pay period. more taxes coming out.
But the trade-off is?
The trade-off is it will either increase your refund or significantly reduce any amount of tax you might owe when you file your return.
So it's all about personal preference.
It really is. It's about your personal preference for managing your money and cash flow throughout the year versus your end-of-year tax situation. And as we noted, it's also that privacy alternative for 4A income if needed, hashtag Tag 26, exemption from withholding, the zero liability scenario.
Okay, let's shift gears to a very specific scenario mentioned on the form. Claiming exemption from withholding.
The exempt status.
This sounds like the ultimate tax saving situation, right? Having no federal income tax withheld from your paycheck at all, zero tax taken out.
It certainly sounds appealing on the surface.
But I imagine it comes with some pretty strict conditions.
Extremely strict conditions and, importantly, potential consequences if those conditions aren't actually met or if your situation changes.
So it's not a choice to be made lightly.
Absolutely not. It's crucial to understand exactly who qualifies for this.
So who qualifies? What are the conditions?
You may claim exemption from withholding for the current tax year, let's say 2025, only if you meet both of two very specific conditions. Both must be true.
Okay, condition 1.
First, you must have had no federal income tax liability in the prior year. So for 2025 exemption, no liability in 2024.
What does no tax liability mean exactly?
It means your total tax calculated on your 2024 tax return, like line 24 on Form 1040, was zero, or maybe even less than certain refundable credits. Or perhaps you weren't even required to file a tax return at all because your income was below the filing threshold for your status.
Okay, so zero tax owed last year. What's condition 2?
The second condition is that you must also expect to have no federal income tax liability in the current year, 2025 as well.
So you need to meet it for last year and expect to meet it for this year.
Correct. Both conditions must be met. This status is really designed for individuals with very low income, perhaps below the standard deduction, or those with significant tax credits that consistently wipe out their entire tax liability.
Students working part-time, maybe, or low-income retirees.
Those could be examples, yes, if they meet both conditions.
So if you genuinely meet both strict conditions, how do you claim it on the W-4?
If you qualify, the process on the form itself is quite simple. You certify your eligibility by writing the word exempt clearly in the space provided right below Step 4C.
Just write exempt.
Just write exempt. Then you only need to complete Step 1A and 1B, your basic personal information, and then jump down to Step 5, which is where you sign and date the form.
And you skip Steps 2, 3, and 4 entirely?
Yes. You explicitly do not complete any other steps on the form if you are claiming exemption. You're basically telling your employer, do not withhold any federal income tax.
Okay. But you mentioned potential consequences. What's the warning here?
It's vital to heed the warning. If you claim exemption, you will indeed have zero income tax withheld from your paychecks. That's the point.
But
This means you may owe taxes and potentially penalties when you file your 2025 tax return if your situation changes unexpectedly during the year.
like if your income goes up.
Exactly. Or if your circumstances change such that you no longer meet that no tax liability criteria. For example, maybe you claimed exempt early in the year, but then you get a substantial raise or start a profitable side gig you didn't anticipate.
Then you might owe a lot at tax time.
You could be in for a very rude awakening, potentially facing a large tax bill plus underpayment penalties because nothing was withheld.
And is this a one-time thing?
No, that's another crucial point. Claiming exempt isn't a set it and forget it option. It's only valid for one calendar year.
So you have to do it again next year.
Yes. You will need to submit a new Form W-4 by February 17th of the following year, so by February 17th, 2026, to maintain exemption for 2026, to recertify your exempt status if you still qualify.
Okay. So powerful if you truly qualify, but potentially risky if you don't or if things change.
Precisely. It requires careful monitoring and a very clear understanding of your tax situation throughout the year. Hashtag Aptamnensen. The IRS W-4 Aptamator, your best resource.
Expert, we've mentioned it a few times now, but let's circle back to it specifically. Throughout the official W-4 instructions, the IRS repeatedly points to one particular online resource.
The tax withholding estimator.
Yes, at www.irs.gov W4AppDop. This isn't just a casual suggestion in the instructions. It feels like a strong recommendation, almost a directive sometimes.
It really is. They push it quite heavily, and for good reason.
Why? Why is this tool so highly recommended by the IRS itself? What makes it such an invaluable resource for anyone trying to, optimize their withholding and make sure their money is working harder for them?
That's the key question, and the answer really boils down to two things. simplicity and accuracy.
Simpler and more accurate than the paper form.
Generally, yes, especially for anything beyond the most basic situations. The IRS promotes this tool so heavily because it truly takes the guesswork out of what can be very complex calculations.
Like the multiple jobs worksheet we talked about.
Exactly. Or figuring out the impact of various credits and deductions. It handles all that complexity behind the scenes. It's designed to provide the most accurate withholding recommendation possible for your specific situation.
Helping you avoid both pitfalls.
Yes, helping you avoid both the pitfall of underwithholding and facing penalties, and the missed opportunity cost of overwithholding, giving that interest-free loan.
So when does the IRS specifically say you should use it? Are there particular scenarios?
Yes, they list quite a few situations where it's particularly helpful or even essential.
Such as?
First, if you're submitting your Form W-4 after the beginning of the year, maybe you started a new job mid-year, the estimator can help adjust your withholding correctly just for the remaining pay periods.
Okay, prorating it, essentially.
Right. Second, if you expect to work only part of the year, maybe you're retiring mid-year or starting a job late in the year.
It adjusts for the shorter work period.
Correct. Third, and this is huge, it's essential anytime you have significant changes during the year.
Like the life events we discussed earlier.
Exactly. Marital status changes, getting a new job, you or spouse, changes in dependents, significant shifts in deductions or credits. The estimator is your real-time adjustment lever for those changes.
What about complex income?
Definitely. The estimator is invaluable if you receive more complex income types beyond just wages.
Like?
Passive income like dividends or capital gains from investments, Social Security benefits, large irregular bonuses, or business income from a side hustle.
Things that don't fit neatly on the basic W-4 lines.
Right. It's also specifically recommended if you anticipate being subject to things like the additional Medicare tax for higher earners or the net investment income tax.
It factors those in too.
Yes. And as we've already emphasized, it's explicitly recommended if you prefer the absolute most accurate withholding for those multiple job situations.
Especially when the simple check-the-box method might lead to overwithholding.
Correct. If you want precision and optimal cash flow with multiple jobs, the estimator is the way to go.
Any other key uses?
One more important one. It can even help you figure out how to pay self-employment taxes from a side business through your regular wage withholding from your main job.
Instead of doing quarterly estimated payments for the side gig.
Exactly. It can calculate the extra withholding needed on your W-4 to cover that self-employment tax liability, simplifying things considerably.
That sounds really useful. Any final tips for using the estimator?
Just to reiterate, always have your most recent pay stub or stubs available when you use it. That ensures it accounts for tax already withheld this year.
Crucial for accuracy.
And remember, withholding isn't static. The IRS recommends checking your withholding using the estimator at the beginning of each new year and anytime your personal or financial situation changes significantly.
So it's a tool to use regularly.
Ideally, yes.
Yeah.
It's truly designed to empower you to get your withholding right. Hashtag tag Strata6 Final thoughts on empowering your financial future with W-4.
So wrapping this all up, what does this deep dive mean for you, the listener? We've gone through every step of the 2025 Form W-4, and I think it's pretty clear now it's not just some annoying piece of bureaucratic paperwork you fill out and forget.
Far from it.
It's actually a dynamic, surprisingly powerful tool, a tool that directly influences your financial present and your future.
Absolutely. Understanding these steps, these choices you make on the form.
It means you can be proactive, right?
Exactly. You can proactively manage your money, your cash flow, rather than just reacting to tax surprises, whether they're big refunds or big bills.
It really feels like it's about empowering yourself to have more control over your own cash flow, ensuring more of your hard-earned money stays where it belongs, which is in your pocket, when you earn it.
And if we really connect this to the bigger picture of personal finance, truly mastering your W-4, or at least understanding it well enough to make informed choices, is a fundamental step.
Foundational financial management.
It really is. It's about ensuring your money is working for you throughout the entire year, every single payday, not just sitting idly with the government until tax season rolls around.
Getting away from that interest-free loan idea.
Precisely. It highlights the power you have to take control of your withholding, to adapt it as your life changes.
And using the resources available.
And leveraging the excellent resources available, like that highly recommended IRS tax withholding estimator.
It really shifts the perspective, doesn't it?
It does. It shifts your perspective from passively accepting whatever tax is withheld to actively optimizing your financial situation.
Which leads to?
Hopefully, greater financial flexibility, better cash flow management, and definitely fewer headaches come tax filing time.
Okay, so armed with this deeper understanding of Form W-4 and how it works, here's a final thought for our listeners.
Let's hear it.
What small adjustment could you make to your W-4 today, maybe using that estimator, that might just put a little more money in your pocket tomorrow or perhaps save you a significant headache next tax season?
And building on that, how might making a regular review of your W-4 maybe annually, or when life changes become as routine and, frankly, as beneficial as checking your monthly budget,
Yeah.
transforming it from just a compliance task you dread into a powerful, ongoing personal finance strategy that truly empowers you with greater financial control and flexibility?